Caterpillar stock is currently up 5.11% year to date, trading at a price of $217 per share. And when you look at the fact that the S&P 500 is down nearly 15% in that same amount of time, combined with the fact that Caterpillar has been increasing the amount they pay in dividends for 28 consecutive years, it is no wonder that dividend investors absolutely love this company. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if this is a stock we should consider buying or selling. And on the spreadsheet, we have four different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation model, and a dividend discount model. And all of these outputs will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So let's go ahead and come up here to the top and plug in Caterpillar stock ticker, CAT, and hit enter. And you can see all of this data is going to automatically fill in. And so like I said, we're currently looking at a 700-day chart. And so we can see while the broader market has had a pretty large decline, Caterpillar's held up pretty strongly. If we come over here, we can look at their dividend data. They're currently paying out $4.44 per share. Their dividend yield is sitting at 2.04%, and their payout ratio is just 36.3%. So this is a pretty safe dividend company. Their moving averages 20, 50, and 200-day are all above zero, which is a great sign. Currently trading at $217 per share. Their industry is industrials, and analysts currently have a price target of $235 per share. Now their 52-week high is $246, so they are a little bit below that, but I think there is potential for them to get back up to that price range. But let's go ahead and jump into our first valuation model, which is Graham's valuation. And Graham's valuation is a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors. And you can see he laid out the formula to calculate intrinsic value for us right here. And the first thing we need is our earnings per share, which we have listed for Caterpillar right here. We're then going to multiply that by 7, which is the price to earnings of a company with no growth. And then we're going to apply a growth rate projection, which the growth rate projection for Caterpillar is actually extremely high at 23.4 for most analysts. We're then going to multiply that by 4.4, which is the average yield of AAA corporate bonds. We're then going to divide that by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it is 4.18, which gives this company an intrinsic value of $381.44 per share. But let's go ahead and jump over to our discounted cash flow analysis model. And in order to perform our discounted cash flow analysis, what we're going to do is we're going to apply a growth rate to the future free cash flows of this company. And in order to do that, you can see I've looked up the historical free cash flows for this company so that I can see the growth rate year over year. So we have pretty consistent growth, except for a few years you can see here in 2018 and 2020. But over these years, we can see we had an average growth rate of about 11.4%. So considering the industry they're in and the historical free cash flows for Caterpillar, I'm applying a growth rate of about 12% for the future free cash flows of this company, which you can see I have applied throughout right here. I then use that growth rate to also calculate the terminal value, which is the sum of all the free cash flows past the year 2030. I then applied the present value formula to these future free cash flows and added them all together right here, which you can see. I then added the cash and cash equivalents and subtracted out the total debt, which gave me the equity value for Caterpillar. After getting that number, I divided it by the number of shares they have outstanding to come to our discounted cash flow price per share of $269. Now let's go ahead and jump over and look at our multiples valuation model. And the idea behind our multiples valuation model is using a price to earnings multiple, we should be able to see how the market is valuing other companies and apply a price to earnings multiple to Caterpillar to see how the market would value them. So what we're doing is we're taking companies like Deere, AGCO, PCAR, we're taking their stock price and dividing it by their earnings per share to see what their price to earnings multiple is. We then took the average price to earnings multiple for this company and multiplied it by Caterpillar's earnings per share, which is 11.92, which gives us our intrinsic value of $185 per share using our multiples valuation model. Now, it is important to remember that during times of a market downturn, all these price to earnings multiples are going to be slightly lower due to all these stocks going lower. So it is also important to take a look at the historical price to earnings ratios of these companies. So I think that's something that's always worth looking at here. But let's go ahead and jump back over and look at our last valuation model, which is our dividend discount model. And essentially the idea behind our dividend discount models, we should be able to value a company based on how much they pay out in dividends and how much that dividend payout increases over time. And Caterpillar is a company that has been increasing the amount they pay in dividends, like I said, for I believe 28 consecutive years, so they have phenomenal dividend growth, and the amount that they've been increasing their dividend payouts has been pretty ridiculous lately. We can see their dividend payouts over the past 4 years right here, which allows me to see the growth rate of these dividend payouts. Now, there was 1 year where they did not increase the amount, but other than that, we can see they have an average growth rate of 9.45%, which is really great dividend growth. Now, for the future, I am projecting a growth rate of about 7.5% for this company. So after applying a discount rate of about 9%, we can come to a dividend discount model price per share of $318 per share. But let's go ahead and jump over to our output tab. And on our output tab, we can see all 4 of our valuation models. Graham's valuation at 381, discounted cash flow at 269, dividend discount model at 318, and multiples at 185. And when you average all 4 of these valuation models together, we come to an intrinsic value of $288 per share. When we look at the current price, we're currently looking at a current price of $217 per share, so that's a 24% difference. Now, we are value dividend investors, so we do always want to apply a margin of safety. So if you're a pretty conservative dividend investor and you want to apply a 30% margin of safety, based off of that, our acceptable buy price for this company is $202 per share. So our valuation spreadsheet is telling us this is not a stock we should be buying. Now, if you're a little bit more lenient in the stocks you want to buy and you only apply a 20% margin of safety, based off of that, our acceptable buy price is $231 per share. So our spreadsheet is telling us this is a stock we are buying. So you can see, regardless of if you want to apply a margin of safety of 20% or 30%, this is a stock that's trading very close to a reasonable acceptable buy price. For that reason, I haven't personally added any shares of this company to my portfolio, but they are definitely on my dividend growth stock watch list. So go ahead and let me know in the comments below what you think of this company, if it's a company you plan on buying or selling or even adding to your watch list. Again, if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.